Hello, I'm Justin Volkmar, lead financial advisor with Correct Capital.
And I'm Jordan Korte, associate financial advisor with Correct Capital.
Thank you for giving us and Correct Capital your time today. It's not lost on us how precious that time is. Today, I'd like to ask a question. While this question applies to everyone, today our focus is really going to be on how this question affects pre-retirees. Have you been watching the roller coaster that is the financial markets recently? If so, you might be feeling a little bit queasy. If that's the case, don't beat yourself up too much. It's completely normal. But ask yourself this question. Is that anxiety due to 1 or 2 bad days on Wall Street? Or because you don't know how those bad days have affected your ability to retire on your terms? Financial complexity is real, and the longer you let that anxiety surrounding it consume you, the more helpless the situation is going to feel. You've worked incredibly hard for your money. You saved diligently and possibly have accounts scattered all over the place. Old 401ks, IRAs, maybe a pension or even a business interest. You haven't given it much thought because sometime long ago, you heard someone tell you they don't want all their eggs in one basket. Well, I would imagine if you talk to a farmer, he or she would tell you, well, you probably don't want all your eggs in one basket. You definitely want all your chickens on one farm. So right now, you might be sitting there looking at a pile of investment statements scattered all over that kitchen table, multiple firms, contact people you've never met, or even worse, an 800 number to call and get somebody different every time. And you may be thinking to yourself, how does this actually turn into a reliable paycheck in retirement? Today, we would like to educate you on some of the biggest financial mistakes we see from pre-retirees and more importantly, how you can proactively avoid them. One of the most common mistakes people make is focusing strictly on investment returns. A lot of folks come to us chasing the next hot stock, which if you've been around or looked at anything in the last 48 hours, you'll know that would be SpaceX, or ask if they should buy a specific financial product their friend or relative just purchased. But here's the reality. I don't know the answer to those questions, because very rarely, if ever, should an investment decision be made in a vacuum. Rarely do we see prospects or clients need to find a better investment. What they need help with is in developing a better plan. Investments are definitely important, but they're only one piece of this puzzle. A true retirement strategy requires a financial rhythm. That rhythm is where your goals, income, investments, estate plan, tax strategies are all coordinated and working together. If you buy a product to try and solve a single problem, you're being reactive. Planning is all about being proactive and coordinating your investments so when opportunities present themselves, we're able to proactively test those opportunities and see what ripple effects they may cause. And are those ripple effects positive or negative?
Mistake number 2, and this one isn't completely your fault, ignoring the retirement tax bomb that may be coming your way. When you're saving for retirement, a giant tax bill is probably the last thing that you want to think about, but for most pre-retirees, that is exactly what they have built. I say it isn't completely your fault because for most people retiring today, the only retirement accounts available to them were what we call pre-tax, meaning that you get the tax deduction in the year the funds were contributed, and the funds grow tax deferred until you need to take those dollars out. With most pre-retirees' wealth sitting inside traditional or pre-tax 401ks, you're also sitting on future bill from the IRS that you may not be aware of. As clients reach age 73 or 75, depending on the year that they were born, the IRS requires each individual to take out what's called a required minimum distribution. These distributions begin and increase over the years, and they can unexpectedly push you into a higher tax bracket, increase the taxes on your Social Security benefits, and even increase your Medicare premiums. To manage this risk, we implement a variety of strategies, or at least discuss them, among those being Roth conversions, withdrawal sequencing, and overall tax-efficient income, which can really give you flexibility later in retirement. Also, if your advisor or someone that you're working with gives you the line of, "I don't give tax advice," you may want to start looking elsewhere. We will never claim to be CPAs or tax experts, but we are knowledgeable enough to educate you on your current tax situation and work with your tax advisor or CPA to come up with strategies that are in your best interest. Remember, it's not about how much you accumulate, but how much do you get to keep throughout your retirement.
The third and final mistake we'd like to discuss today is one that we've kind of hinted at throughout the discussion, and it's really disorganization or siloed advice. Think about it. You've got a CPA who helps you with your taxes. You've got an estate attorney that helps you create a trust. Your financial advisor manages your investment portfolio. But who's actually the individual that coordinates and connects all of these things together? The answer for many of our clients is it's them, or worse, it's nobody. And that's often where some of the most costly mistakes occur. At Correct Capital, we believe complex financial lives require that collaboration. Our team works together to evaluate planning opportunities from multiple perspectives while coordinating with those individuals, the tax preparer, your estate attorney, and any other trusted advisors that you may have. It's about creating organization, accountability, and alignment across all of those decisions, financial as well as the rest of the other portions of your life. Retirement planning is so much more than just reaching a specific account balance or a specific rate of return. It's about stewardship, protecting your family, creating confidence in achieving your financial independence, and building a plan designed to help support your lifestyle, regardless of what the economy or markets may be doing at the time. You deserve a trusted guide who helps simplify complexity so you can focus on what matters most. At Correct Capital, we don't sell gimmicky financial products or chase trends. The only thing we strive to achieve on a daily basis is to achieve your trust.
If you're approaching retirement and want to have a better understanding of your investments, your retirement income, and your tax strategy, along with all the things that intertwine, we encourage you to take the next step. Visit correctcap.com to learn more about our planning philosophy and how we help simplify financial complexity. Thank you for watching, and I hope you have a wonderful day.